Hello everyone, welcome to the GrowCast show. This is episode 124. My name is Yu Hong and I'll be your host for today. And today in our studio, we have Megan Yvonne, a group director in PropNex. Let's get to our questions. So Megan, will Singapore property always appreciate in price?
I would say that if you really study the graph, right, since 1975, our parents' era to even now, right, definitely along this whole journey, there is up and down cycle. But if you really look at the entire graph itself, it is actually a very stable, sustainable growth in our property cycle in Singapore. So I think the key thing is not about whether are we buying into a hype of I want to buy today, I want to flip tomorrow into a speculation, but I think it's really into long-term, mid to long-term time horizon outlook that this is actually a asset class that really protect your capital and it actually grows very stably.
Are property agents over-promising on capital appreciation?
I would say that definitely when we buy into an asset class, we all wish for hope for appreciation that our capital is being protected. And I would say that so far, if we really go into assets, and a lot of time I also always advise my client that if you want to buy into a property, right, really look into something that is for a family to live in, and you really look into a mid to long term, because this is the time, right, where the appreciation will be slow and steady. At the end of it, right, don't go in with a mindset that you're just going to flip it in the next 3 years, 4 years, that sort of thing. But really, there is a calculated risk, and that's definitely analysis where we actually help our clients to really study which is to buy in safe entry price.
So Megan, if interest rates are falling, what historically happens to property prices?
So historically, whenever interest rate falls, right, we actually see volume comes in. So when there's market demand are confident, when the volume comes in, that is where, do you think as a homeowner yourself or be as a developer launches, right, do you think usually they will position the prices to be higher or lower if there are demand coming in? Who will be more confident? Because everybody will be thinking, borrowing cost is low, leveraging is low. So this is the time for me to buy into assets. So this is where the volume come in. So previously, when the cycle in 2021, 2022, when we see that interest rate was near to 1% and below, that is the time also where we actually see prices in new launches where it actually can increase from 20 to 30%. Yeah, because the demand come in. Yeah, so that's also in general, I would say that we call it the dollar averaging. So usually when the prices will be slightly more lower when there are people who are lesser people coming into the market. So when the demand start to come in, then that's when the confidence also rise.
So Megan, why are developers still bidding at high land prices?
Okay, I would say that developer in that sense, they don't gamble in terms of millions of dollars to buy into high land costs, right? But they also look into projection or replacement costs. So what I mean by replacement cost is as such that down the road, they need land banking in that sense. So with this land banking, they also need to factor in what is the land cost and then the construction cost and all this. So moving forward, I would say that the land scarcity down the road is actually causing this land cost increasing. When a developer actually bid high land, right, when there are a group of developers in the sense that they actually have to outbid each other to actually win the land tender. So in that sense, when they wanted to win the land tender, I have to bid a certain price so that I can confidently have this land banking in that sense. So if you look at it, developer also understand the future, the demand, and which take a few fundamentals to look at it. So one of which is, of course, we know that interest rate is one of the borrowing factors that actually bring buyers to actually come in confidently to purchase. And then at the same time, what are the future replacement costs? So I would say that there is a structure where they are actually looking into all this, which when the developer are confident in bidding land, it also shows that the developer are far-sighted to also can project the future to know that buyers are actually coming into the market when interest rate borrowing is actually getting lower.
Okay, so Megan, River Valley was bidded at 1020 per plot ratio in Zion Road and was launched at 3,050 per square feet average selling price. And in Bedok, next to Tanah Merah MRT, was actually 1,330 per plot ratio. So based on all these land economics, right, what would launch prices look like in 2026?
Yes, you're right. So earlier we actually mentioned about interest rate, right? So interest rate also drive the confidence of developer land bidding costs. So you are right to say that Zion Road, that one that was actually bidded in 2024, it was actually bidded at 1,202 PSF per plot ratio in 2024. But if you recall, in 2024, what are our interest rate like back then? It was actually, a lot of people was trying to do refinancing back then, if you recall, and that was actually, interest rate was actually close to like 3%, plus minus, right, ranging averagely above 3%. So at this current juncture that we are speaking, right, do you know what is the current interest rate from 2024 to now at 2026?
It's higher than before?
Yeah, not back then it was like 3%, but now at this juncture it was like below 1.5% interest rate. So we are talking about almost half, right? So of course, through this measure alone, this single indicator, I would say, like you could see that interest rate are falling, developer interest confidence are gaining. So they also outbid one another. Do you know that there are actually 6 high bidder, right, that bidded above the 1,200 per plot ratio PSF. So in that sense, of course, then the final one was actually got at 1,330 PSF. It's going to be next to Tanah Merah MRT, this land. So if you look at it, am I right to say that eventually this launch, which is actually bidded last year, the land in Bedok, right, it's going to launch in 2026. So which means to say in the mid-term of 2026, if back then it were valid at 1,200 per square feet per plot ratio, it was done averagely at above 3,000 PSF. So knowing that this real Bedok one that actually bought at the land cost, the land was actually bidded at 1,330 PSF, do you reckon that it's going to be quite similar to like I used to be paying 3,000 for Real Valley? I might possibly be paying close to 3,000 now for Bedok. Yeah, which there will be like we are talking about CCR versus OCR price.
So Megan, why for new launches and resale, there's a price gap of 40%. So why are still people buying new launches instead?
Okay, for new launch, right, developer are actually pricing it forward. But for resale market, they're actually pricing it backwards. Because as we know that for every buyers who actually buy into property, the one thing that we need is valuation. For the bank to follow this bank indication valuation in order to borrow the loan to the buyer, right? So in that sense that for new launch, the developer actually price it forward in a sense that whatever they call the price, right, the bank valuation match. But for resale, right, the bank valuation has to depend how much your past transaction of your last 3 transactions, which goes to show that if the volume will determine the movement of the price, movement of the valuation, how fast it will actually move up. So that's why a lot of people were still in a sense that though despite its 40% price gap, in view of the long term, like the developer actually their valuation actually match at every stage when they actually move out the price. But for resale, right, to have, let's say today I buy 1 million, I wish to sell like 1.3 million, let's say 3 to 4 years down the road, I need to depend if my valuation can move out that fast, which depend then on your past last 3 transactions, which is how much your neighbor is selling. New launches is actually determined by developer.
How do banks actually value new launches and differently from resale properties?
So basically for new launches, bank align their prices align with developer. But whereas for resale market, it really have to depend on the past data. Past data, which means the last 3 transactions. So it really depends the volume of people who buy into that resale development, then it actually give the indication how fast it can move.
So Megan, how can buyers enter with price protection instead of speculating the market?
I would say that for the buyers who actually go into price protection, there are a few indication and structure to look at it, of which I would say one of them is like, for example, let's say I'll do an analysis, which means to say, if I know that, like earlier we mentioned, right, the Bedok is actually going to launch likelihood at the land cost that they beat, following close to River Valley launch price, which is about close to 3,000 per square feet. So let's say if I'm actually going to do an analysis about the price around there, right, I will buy somewhere similar there, and not I will also study the tenure, the age, and all these things, and then the layout. So there are a few factors to actually look into and study. But key thing is also I will actually then hedge against, like just to see that, hey, if my resistant price is 3,000 PSF, let's say today I actually enter a fairly new resale there that is at 2,000 PSF. Then I know that I have a gap of 1,000 per square feet. And let's say my floor area is 1,000 PSF, 1,000 square feet. Then I have a price protection of 1 million. So the replacement cost in future, there is a gap. So that is where I usually study. There is a few indicators to study to determine which is actually a safe entry price.
So Megan, what is this V-shaped entry strategy that you have developed, and how do you identify it?
Okay, I would say that a lot of people are concerned about, like, if I sell high, am I buying high? You see, because in today's market, a lot of people will be concerned about is the price, went up quite a fair bit in the past few years. So they be concerned, then should I move forward? Or should I hang on to what I have now and just fully pay up and play safe? So my key question here is, you look at the past few years, yes, across HDB or any assets class, condo, lender, they have all appreciated. So my question is, let's say, for example, if you're HDB upgraders, you have been staying in this HDB for the last 7-8 years, and it has appreciated. So is it a situation where if you sell at this price now, and then if you were to change to another assets class, right? I would say that if you actually change to another, reposition your funds to another new asset class, that is where you are actually entering low, because this is the time where we actually do market analysis, price analysis, like what we shared earlier. You know, if this is my price that is up and coming, then where is the entry, that is a protected entry price that can actually go in safely, so you can actually poise for the next growth. So you capitalize and you actually lock in your today profit, and then you reposition yourself, right, for the next growth.
If I sell high, am I automatically buying another high property as well?
Yeah, I think if you sell high, let's say, for example, if you actually buy in the same market, right, or the same assets, for example, like I sell a resale condo from this estate, I move to the next estate, and then I'm buying the same three bedroom, then I would say that fundamentally it's actually pretty much sell high buy high, because you're actually selling your resale, passing a profit to your next seller, I would say. But if we really analyze the entire market, then that is where you can actually lock in your profit, which you are sitting on already, and then reposition them to another new market, which you can actually analyze to enter at a low.
So Megan, how do you identify potentially outperforming resale properties?
Okay, so there are some resale properties which we will look at, right, that potentially will outperform. And why do I say that is that they are evergreen one, you know. It's like in the sense that when you go there, right, the few good factors is really position itself on. Like when you enter into the development, there's a certain land size that we look at, there's a certain facilities, and then the overall layout and everything and price point. So this is the part, right, that is evergreen. What I mean by evergreen is that a lot of families, they will want to buy in there for their families to live there happily, for children to grow up in, and that's when it draws in demand. So just how we mentioned about resale market, it depends on valuation. So when all these drawing factors to pull in the volume of buyers, right, it actually create a very strong valuations. Then that's when the value of that resale market will stay strong and it will grow.
So Megan, what key government policy shift should we watch out for in 2026?
Okay, so there are a few key fundamental policy that has already announced end of 2025, which a few of them would be, one of the key fundamentals one is that 15 months wait out period will be removed. So which means to say, imagine if you are homeowners, you are private homeowners, right? You sell at a good margin already. You want to, let's say you want to like retire or buy a big spacious unit, you have to wait for 15 months, right? So that's when most of the time, this will deter the people from selling, or it will sell already, they will have to go and rent for 15 months before they can buy a HDB for own stay. And imagine if you are the seller who actually sell your private property, each time you want to sell, you want to buy a HDB, likelihood you'll be buying a 5-room or bigger house or family, right? But this is the moment where even after 15 months, you are restricted to 4-room and below.
So how will prime and plus HDB classifications impact the resale value over the next 10 to 15 years?
Okay, I would say that for this prime and plus resale, when they come into a market, let's say down the road if we fast forward 10 to 15 years later, right, it means to say that this group of people, they have the MOP not just 5 years, but 10 years. And this group of people, when they sell at 10 years later, let's say you sell at $1 million for your HDB 10 years later, there is a percentage of clawback, which is maybe about 12% averagely clawback for your overall resale price. And on top of that, the buyers who buy your HDB on this resale market have to be kept within the income ceiling, which is as if like they are buying a BTO flat like that. You have to match the income ceiling. Let's say today as a buyer, right, I have to buy resale HDB because I don't qualify for a BTO because of income ceiling. But this prime plus flat, right, I have to qualify an income ceiling. So even though I want to buy a flat, I'm not qualified to buy a flat. Does that mean that your pool of buyers will shrink? And what happens when your pool of buyers shrinks? Because of the limitation. The fact is that this prime and plus flat, you cannot rent out the entire flat. It has to be like a room rental sort.
What is the difference between SERS and VERS, and why does it matter?
So, SERS, for that matter, is that it is actually already happening like 10 to 15 years ago. I would say the most recent one that happens is within Queenstown and Kallang area. So let's say this prime area for SERS is a compulsory en bloc by the government. So these people, in a way, I would say it's like a windfall for the homeowners, because, for example, your 3-room flat that is like 30 years old or 40 years old, I come in to actually give you a replacement flat that is within the same area, brand new one, and then I buy at the market value of your old flat. So which means it's actually literally a windfall for these homeowners, because it's a replacement flat, a brand new one, right? But I would say the new up and coming, which is VERS, will overtake SERS. So VERS would means that HDB that are like 50, 60 years old down the road, when aged at 60 years old, right? It won't be like compulsory en bloc already. It will be by ballot and by the homeowner discrepancy, which means, for example, I need 60% of people who approve that they allow en bloc. Then en bloc can go through. If not, right, I think the most biggest concern for every decaying lease is that what if I hold a decaying lease property and then the lease decay, which is a matter of time, and what will be the diminishing value at the end of it.
So with 2026, we will see a major MOP and TOP supply. How should buyers then position themselves this year?
Yes, there is a major MOP, TOP supply of HDB in 2026. And I would say that this is where buyers can actually potentially look into how to position themselves to actually for their next stage. So like a lot of young couples, when we first start out, right, we actually get BTO, so a subsidized flat. So from there, when it actually mature already and MOP 5 years, this is the time where you can actually look into your positioning at the next stage of your life already, because you have amassed, you have built out your CPF savings, and your property of your first asset class, which is your HDB, has also appreciated in value. So now you have cash, which is your profit. You have your CPF that is also built up along the years. Then what is your next best option for you to continue to journey yourself to actually build a bigger net worth for yourself? I think fundamentally what we are looking here is not really to speculate or to confirm that buy ABC property will confirm capital appreciation. I think what we are looking here is really to slowly build up your net worth like your first HDB might be 400-500. Then your next one you might upgrade to a 1 million, to a 1.5, so slowly when you build out your net worth. So end day when you retire at age 65, right, you have something to look back. You can actually have options that you can buy a 3-room flat for you to retire in and still have a respectful retirement.
And so Megan, what is RAM, the risk assessment method in property strategy?
Yeah, I think before we even look into which property to buy, whether it's a HDB, condo or landed, right? Most importantly, I always structure for my client how to look at RAM. RAM is actually a risk assessment, right? Which I think is very, very important to a lot of buyers before they enter into property. First is that what is the amount of liquidity? Basically, is like what is the resources that we have plus the CPF, so that we will actually position ourselves that to actually put a part of it as to weatherproof as our form of savings. So in that sense, right, should we actually decide to take a break from our job, be it is for a 6 months period or for any unexpected situation, we can actually safely do not need to fire sale our property, but have the holding power to actually ride through unforeseen circumstances.
So Megan, what are the 3 P's in property?
Okay, the 3 P's in property will be that, let's say for example, I have a property A and I'm collecting rental every month. So every month, even let's say for example, today you buy 1 million. Let's say 5 years later, when you sell at 1 million, do you think you meet or gain? You think you lost to inflation, right? But actually in these 5 years, right, you could actually encash out the principal, which means this tenant actually pay your principal to this bank, which is your saving bank, in the sense that they actually pay to you. So 5 years later, which is 16 months later, you will encash this principal that your tenant has been paying. Yeah, so that one is actually more to the principal that they pay down to you. And let's say if there is a passive income along the way, that is also the liquidity that you will be receiving, the passive income every month. So of course, then last but not least is the capital appreciation, whether you are selling at what margin or not. So the 3 P's are principal growth, passive income, and profit potential.
Should I save first to buy an asset, or buy an asset then I create the savings?
Okay, so I get this very often where a lot of people are very concerned that I must save enough, then I enter the property market. But so as I mentioned, right, property, look at it in more of an asset class that actually safeguard your saving in a sense. So whatever that we have, right, buy something that is comfortable to you. So I think most important is we grow our assets along the way as our income grow. Then we can actually, that's where, like for example, your first house is BTO, and then along the way you actually increase your capital, your net worth that will grow in tandem with your income.
If I have 200,000, should I clear my loan as soon as possible or deploy it strategically, or how would you deploy it?
Okay, so there is a good and bad debt here. So let's say for example in assets, right? Let's say depending on every individual, their age, their income, and our MAS framework. So at the end of the day, let's say I'm at 35 years old versus I'm somebody at 55 years old. This is the moment where we will actually deploy this cash flow strategically depending on their age group. Oh. So let's say if I'm at 35 and I can stretch my tenure, and let's say if I stretch my tenure and the interest rate, like I say now, is actually below 1.5%. So let's say if it's just a difference between, because of my tenure, right, it's just a difference between $500 more interest rate every month. So is it worth for me to down pay the 200,000 versus I use this 200,000 to actually put somewhere else, will I actually gain more in terms of its spread?
Or how would you future-proof property decisions to create a respectable retirement for yourself?
Okay, so I feel that a lot of people who go into property, they will hope that, you see, if I want to buy into property A, am I hoping that the price will profit, for example, double in that sense, or so on and so forth? But versus another question would be that, let's say if I buy into 4-5 million property eventually, right? So that is my net worth. But my main aim, end of the day objective, is I fully pay up. So at 65 years old, that is my end net worth, that I have a fully paid up net worth of 5 million, for example. And I have option to scale back. Be it I want to buy a smaller place house or another options for me to retire in that sense, rather than, let's say, for example, a lot of them, they always say that, hey, my parents last time buy this house, only 20,000 only. And then today, right, the house worth 500,000. So do you think this 20,000 become 500,000 is better? Or do you think that, for example, you own a 5 million property, but it did not grow. Let's say it did not profit at all, but you fully pay up already. A lot of them, they will think in this manner, right? The first one sounds better,
That's
right?
growth.
Then my question is that it's growth in this, but it has 20,000, it has grown to 500,000. But on hindsight, now moving fast forward, right? Our parents is in their retirement age, right? So let's say they want to retire already. And then what are their options? Can they actually sell this 5-room flat and then they scale back to a 3-room? And do you know that today in our 3-room flat in Clementi, how much is actually transacted already? It's actually more than 500,000 already. So imagine if your parent were to actually own this 20,000 flat that now worth 500,000. Are there options for them to scale backwards?
No.
So in a way, they are stuck, right? So that is why many times I would rather look at building up the net worth that give us option when we can actually decide to take a break from our job. Life throw curveballs at you, or that, when eventually you are retire, you have option to retire.
So Megan, you often say property should protect you, not pressure you. What made you see it that way?
Okay, because I've been in real estate since 2010, and along the way, I've actually built assets that actually tie me through during my most challenging and tested period. There were times where I really needed time to recover, time to be a mother, and it was actually the assets that I built, right, that really helped me to tie through those moments. And it's not so much about how much I hustle, but it's really the assets that I built that really tie me through and allow me to rest and create options in those tested moments. So that is the reason why when I strongly believe about buying protected property prices that really not just any property, but really carefully analyzed before you buy into any of them. And that because property is so dynamic, market changes, policy changes, prices change before our income change, before even our income catches up. So this is something which I feel that if you've done it right, you've done it safely, it actually outperform and really safeguard you. So like I say, in view of this, I really believe strongly in assets to buy, to protect your future and to live by design. And that is why I felt that every step of the way, it's not just about buying property. It's not just about buying to any hype. I think it's really more about buying what suits you at what stage of your life, that it can actually protect you and weather through when life throws you a curveball. Yeah. So I really went through that, and I really felt that I'm very thankful that there are some property I buy, it didn't mean as much as I hoped to. There are some that I bought and it really helped me through. So I've been through the ups and downs of cycle in the last 15 years since 2010. I really see the cycle, the policy changes and everything. But I feel that really it's not about waiting. It's really to what is your current stage, and then how do you build something to protect yourself that can actually help you through the later years in life.
Okay, that's all the questions we have for today. Stay tuned for episode 125.